Hello, everybody. Today we're going to talk about making a trade that's not in the market. Basically, you're making a trade, a limit trade, that when it gets to a certain number, the trade will happen for you. So let's go right into that. Let's go to Bitcoin. And if we click right here, it says what? Order type. Order type. All we do is we switch this and we want to do a limit trade. A limit trade, okay? And this is what the limit is. If it hits this price right here, it will get into the trade. So what do we want for the limit price we're selling? So that would mean if it goes up and hits this, it'll start the trade. So we're going to go ahead and put that in right there. And there it is. It hit that number and it started the trade. That's how fast it went up. Bitcoin moves really fast. So we're in that trade right there. We see it. Let's make another trade, and we're going to go down again, and we're going to do a stop trade, a stop trade. What does that mean? That means if it gets to the area, and let's do one right here. It's at 757, so we're going to go ahead and go to, let's just do 800. Let's look at 800. I believe it will go there pretty quick. And if it hits that 800, it's going to start it out for us. So we're in that other trade right here. We're in a sale for that one to go down. And we're already in this trade right here that's making a lot of money for us. So the other one did not hit. The stop one did not hit. And so I want to show you guys something before the stop one hits. Let's go to a limit market trade. And this is how, people can find out things. This is a market trade, a limit, and a stop order. Let's go ahead and go to the Schwab and let's read about this a little bit here together. What is a market order? The market order basically means that you're taking the trade right then and there. It doesn't matter what the price is. You push the button, you're taking the trade. So what is a limit order? A limit order is an order to buy or sell a stock with a restriction on the maximum price to be paid or the minimum price to be received with the sell limit. So what we're doing is we're taking a trade. If the trade goes up here, we're going to take it to sell. So you're setting up a trade up here. If the market hits up here, you're going to take a trade. And what just happened? It just took our stop trade right now. Let's go back. And we're in that other trade, the stop one. And now we're in both trades that we just made, and we're in the other one that we're winning. Let's go back. So the limit trade is if it goes all the way up here, it will do a sell. If it touches down here, it will end up doing a buy. So this would be where the market is right here, and you see it right here. And so if you take a trade at market level, you're going to take it right where it is. If you take a limit, you're going to have to wait for it to get up here or down here. And usually people put the limits to buy at the support, the bottom of the trade, or they put the limit to sell. They put the limit to sell at the resistance up here. So the limit to sell would be at the resistance. The limit to buy would be at the support. Okay. Now, let's go and find out what a stop order is. What is a stop order and how is it used? The stop order is an order to buy or sell a stock at the market price once the stock has traded at or through a specific price. If the stock reaches the stop price, the order becomes a live market order and is typically filled at the next available market price. If the stock fails to reach the stop price, the order isn't executed. So, long story short, when a stock you already own has risen and you want to attempt to protect part of your unrealized gain, should it begin to fall, and then you're going to get out. So a stop order is sometimes referred to as a stop loss order because it can be used to help protect an unrealized gain. Okay, so those are the two different ways that we could basically use these. Look at our prices now where we're here. We're on these buys right here. Let's get out of this sell. This sell is going the wrong way for us. So we're going to get out of that. All right. We got out of that trade and now we're right here. And we're looking at both of the trades that were up and we're winning right now. And the way to get out of these trades is the same way to get in. All we're going to do is we're just going to stop. We're going to stop our trade. So let's go to it, and we're going to say that we want to stop this right here. It's 1,000. And what we're going to do is we're going to close the position. Very simple. And now we're going to close the last trade. And there it is. We closed all our positions now. And you should see this one go down. We just won 1,700. Let's go to our trading journal and let's see what happened here. So on our trading journal, we can see that we won 1,495. We won 1,008. We won this right here, 553. So we won all these trades right here. And there we go. All right, you guys, hopefully you guys learn how to do that. It's very, very simple to take a limit. You're not going to really need to do the stop. Don't worry about the stop one. The one that you're going to usually make is the limit. The limit means that basically when it hits where you want to take the trade, it will automatically take the trade for you and you'll be able to get in, move, and groove. You could also do a limit like this. Do a limit and then do a protective order. You want to get in when it hits. Let's say you're selling. Let's say you want to go up more. Let's go 200 because it's not there yet. But we want to also have a stop loss. So once you get in this trade, if it keeps on going that way up, then we're getting out at 96,400. And then we want to take profit. And if it goes up to that and takes the trade at 96,200, then you want to basically get out of the trade at 0.0. And so you would make $1,000 or you would lose $1,000 depending on how this is. And all you do is say send order. And now you have a whole trade that if it does hit that, you could either make 1,000 or lose 1,000, but you're outside the house. You're going to work. You're doing what you got to do, but you basically set up the trade looking at the support and resistance. You took the trade. Like, it would be good to do something right here. Let me show you guys this. So if you took this trade, we would be talking about something like this, where you have the support or the resistance up here. You have the support. And basically you're saying that you want to take it down if it goes over here, or you want to take it up if it goes down here. Now you can see if you put a limit down here for it to go up, let's just say you did it on this line, it went down a little further, but it wouldn't hit your stop loss, and then it would have went up. And then what you do is you get out up here at the resistance. So put the take profit at the resistance. It hit the resistance, you would have had your money. And then you do it again when it comes down here. You get out up here again, and you could have won repeatedly over and over. Like right here, you could have won again. You could have won again. So that's what a limit really does for you. It really helps you out, control the market, and get to doing what you want to do, but the market's moving and you're making money. All right, you guys have a great day. Hopefully you guys learned what a stop or a limit is. Limit trade. A market trade is just a regular trade. When you just regular, every trade is a market. So if I hit send, it starts. If I hit limit, it's going to hit that. If I hit stop, it's going to hit that. Don't worry about stop and OCO. You don't have to worry about that. The only thing you're really going to be doing is market trades or limit trades. Those are the ones that really work for what we're doing. All right, you guys have a great day.